Okay, so we've heard lots of ideas throughout the day. We really want this last session to really try and, as we've titled it, bring some order to this. What does all this mean for our client portfolios? Let's sort of go through what have been some of the key outtakes, some of the key discussion points today, and what can we really arm you with as you go back to your practices, go back to your daily jobs tomorrow, that really either give you extra conversational points or maybe cause you to think differently about the ways or means with which you've been doing some of these things. So for the last session of the day, I'm going to turn it over to Heather, who's going to be moderating a couple of us.
Great. Well, we've just realized we don't have enough seats up here, so I'll stand. Just doesn't seem right for any of the panelists to stand. So we're really trying to use this panel, this session, to wrap up what we have been talking about all day long, and I think we have a really great opportunity to do so with these three panelists. So I think you know them all by now, but we've got Tim and Chris from our manager research team, and we have James Foote from Morningstar Investment Management to help draw things to a conclusion. Do we have any polling questions? No. Okay. All right, well then we'll just kick right off with my questions. But if you submit your questions via your app, I will see them on my second iPad. So, so submit your questions, whatever it is you're wondering about from the day's panels. So to start out, as we work on trying to find order in the disorder, as the title of today's sessions has been, what are your expectations for returns? Do you expect a low return environment to persist? And what can investors do to navigate a low return environment? So should we start with James? Sure.
Yeah, thanks Heather. Absolutely expect a low return environment to continue. I think there's a number of things that have come out of today around what exactly investors can do to increase the probability of success. First and foremost, key theme throughout all of today has been the importance of investing for the long term. I think Tim did a great job in his session highlighting the consequences of not thinking long term. We know that on average investors do make bad decisions. That is the essence of the behaviour gap. They buy and sell at the wrong time. The good news is the role of the financial planner here is critically important in helping investors make better decisions to close that gap, to think more long term in nature. So that'd be the first thing I'd say, think long term. The second thing I'd say, good investors need to think independently. This notion that risk can be measured by the extent to which a manager departs from the index or the extent to which a manager departs from the peer group, I think is highly questionable. It's like sending a boxer into the ring with instructions to stay 1 or 2 points ahead of their opponent, rather than giving them instructions to win the match. It was John Templeton who said, it's impossible to produce superior returns without doing something different to the majority. So the second thing I'd say is good investors need to think independently. Thirdly, in the current environment, I'd say it's very important to be valuation driven, more important than usual. In an environment where markets are quite expensive. On the equity side, you have elevated multiples. On the bond side, you have interest rates that are below long-term averages. The prospect of generating average returns from this point in time are very low. And so it's critical that investors are valuation driven. That is, seeking out those opportunities that are attractive from a risk-reward perspective, staying away from those assets that are unattractive, and ideally doing that within the context of a very large opportunity set. Fourth thing I'd say, and it was touched on by Andrew Lill today, was the importance of having correct behaviour. That is, the importance of investing more rationally, than the typical investor. And this comes back to the first point. If you invest more rationally, you're going to generate better returns. It's not easy, particularly if you're valuation based. Investing in undervalued assets is inherently uncomfortable. Typically undervalued assets do have something wrong with them. They do have something driving down their price. And the question is whether or not that factor driving down the price is temporary or permanent. But the rational thing to do in instances where it's temporary is to hold that asset for the long term and wait ultimately for the price to move back towards the intrinsic value. So they're the 4 things that I'd say that investors do in the current environment to improve their probability of success.
I guess I'd add to that is you're trying to control what you can control. So there's certainly lots of talk that most traditional asset classes are overvalued. That may or may not be true, but that's certainly a fairly popular view in today's market environment. And Whether that does or doesn't turn out to be true, as an advisor, ultimately, there's very little you can do to control that or affect that outcome. And so, what can you do to affect and control and improve, client outcomes? Goes to some of the other things we've talked about today. So whether that's having the right tax structures around your clients' portfolios, whether that's a greater focus on the magnitude of costs you've got in portfolios, or whether that's this sort of timing and this investor behaviour issue that we've sort of talked about in a number of the sessions. Certainly, if you think about some of those behaviour gaps I referenced earlier in my presentation, if you think about in the context of over the last 10, 15 years, behaviour gaps of 1%, 2% in that vicinity, in a market where you've done 8, 9% total return over that time period, your outcomes are still okay. But if we do have a sort of lower return market environment from here, yet similar behaviour plays out, that 1 or 2% on a 4 or 5% total return is a much bigger proportion of that, and therefore infinitely more important in terms of the decision making. So I guess the thing I'd really reiterate at an advisor level is you really try and control the things that you do have an ability to influence in that respect.
We have a great follow-up question from one of you. Thank you very much. Given high multiples for equities and low interest rates for bonds, what would you believe is a realistic per annum return objective for a mid-risk investor?
James?
Yeah, for a mid-risk investor, I think throughout the cycle it's going to fluctuate. From this point today, I think it's going to be very challenging to produce returns of CPI plus 3 to 4 at this point in the cycle. But again, there are going to be a number of things that investors can do to improve the odds of success. And so there are a number of things they can do also to reduce the odds. And so, but by investing in the right assets, I think 3 to 4% over CPI should be achievable.
Great. So I think one of the topics that's come up during some of the sessions today is the interconnectivity of different asset classes. And so I'm curious to hear your views on, what do you think about the level of interconnectivity between asset classes? Is this an increasing issue? How should investors be armed or be ready to deal with this issue?
We certainly heard a lot about that within the context of the fixed interest discussion earlier on. The role of bonds in portfolios. Do they still play a role given where interest rates are today? Historically, obviously, bonds have been your core diversifier, but interest rates, in theory, can only go so low, even though where we thought those theoretical lows were have been certainly tested in recent years. I think we saw some of the correlation charts of bond markets to equities through time. Those relationships, they fluctuate through time. To date, they haven't really broken down. I think it comes back to the old adage, not putting all your eggs in one basket. With an environment where equities sell off heavily, could bonds also sell off heavily at the same time? Possibly, but equally too, it's hard to sort of imagine an environment where you're going to see massively rising rates where you've got sharply falling equity markets.
And I'd just add to that in terms of, I think it's really important to understand the role that a fund's playing in a portfolio, or whether it be an ETF or individual security. Why have you chosen to allocate to that investment? There might be there's going to be certain market conditions where different investments are going to perform well and where they're going to underperform. And I think understanding that, not being surprised by it, but getting that true diversification benefit is really going to help you. And there are a lot of linkages globally around the different investments and correlations in asset classes. There's just no doubt about that at all. But I think if you're making sure that you're understanding the type of investment that you've got, the biases that's got within the portfolio, which comes back to Anthony's point about portfolio holders disclosure, then it makes you so much more armed to be aware about or understand what's going to happen when markets do fall or you have a surprise event in some way, shape, or form.
Well, that I think. Oh, did you want to add something, James?
Yeah, quickly. I think this is a really important topic. It really emphasises the importance of thinking about the underlying cash flow drivers, and how assets will perform under various scenarios. Scenarios, for example, like high economic growth or low economic growth, or high inflation, low inflation. And having a genuine mix of assets in the portfolio that will perform under a range of scenarios. It doesn't make any sense to have assets comprised in the portfolio exposed to one single factor. If I think back to the beginning of last year, you had valuations in emerging market equities presenting as being appealing. At the same time, you had valuations for emerging market debt presenting as being appealing. At the same time, oil prices were falling in energy markets too, presenting as being appealing. And high yield bonds in North America too were starting to screen quite attractively. And so a portfolio comprising only of those securities potentially would have been very exposed to an adverse outcome in China. And so it wouldn't have made sense to have an asset comprising only of those. Absolutely would have made sense to have those assets in portfolios, but not completely. So thinking about fundamental diversification and cash flow drivers, I think is really important.
Well, I think that leads well into another audience question, which is which asset class sectors are the most appropriate to be entirely passive right now?
That's a great question. We've significantly increased. If you went to the direct investing panels that we had upstairs, we've really increased a lot of time and effort into looking at passive investing. That's not to be mixed up with, I think, some of the what we call strategic beta funds, which in my view are a form of active investing if you're looking at getting exposures to certain factors. At the heart of it, when you're looking at, there's certain asset classes where, there's no doubt if you're looking at just getting exposure to US equities, getting exposure to, Australian listed property, where we have got a pretty high rating on passive funds within those sectors. And at the same time, I think there's very good reasons for having going in passive across a broad range of sectors as well. I would say that as a research house, we also believe that we can pick good active managers as well. And again, understanding the role that they're playing in the portfolio, understanding the investment style that they've got is critical to getting that. But you can certainly achieve the best outcomes as well.
So are there any areas where you would say no one should go passive?
So Aussie small caps,
works?
without doubt.
Yeah.
We would definitely be pretty critical about someone going passive in Aussie small caps, especially market cap weighted.
Did you want to add something, Tim?
Yeah, I would agree with that. And that's despite probably an index exposure in small caps probably having its best ever relative year in the year just gone. When there's obviously vagaries, particularly the resources mining exposure in that part of the market that tend to flip and don't work out so well over the long term. I think more broadly on the passive side, I think it's a lot of the growth we've seen has come for reasons of cost. So a lot of the headline debate is about active passive. What we think is actually the more realistic issue playing out is high cost versus low cost. Scott certainly talked in his presentations about that being a big driver of portfolio decision making, and that's certainly something that we view as a structural change in the industry that isn't going away. And so, to the extent that that's going to continue to see money flow into passive, we think that's likely to continue. In terms of whether that's right or appropriate, I think you hear again lots of law of averages. The average active manager underperforms. That number sort of fluctuates year in, year out. 2016 was a particularly poor year for the average active manager in most major asset classes, global equities, Aussie equities, only circa 20-30% of managers in the Australian universe at least, outperforming the relevant indexes. So I think there's still passive can still play a role in some of these, but it's not an either or consideration, right? There's a role for both.
Right. We've gotten a couple of questions about alternatives and the role alternatives play in portfolios, as well as a question around that during one of the sessions, the audience preferred alternatives to Aussie equities. So tell us a little bit about your view on alternatives and how they can fit in. James, do you want to kick off?
Yeah, I think it comes back to diversification and ultimately having assets in there, in a portfolio that again are subject to different cash flow drivers. Right now today though, alternatives, to the extent that they don't have valuation risk, can play a really important role. And so if you think about assets that aren't overvalued, and to the extent they're in an alternatives portfolio, I think they are really important, more important than ever.
I think there's two parts to this question. You certainly see this in how people's exposure to alternatives has played out. There's the asset allocation decision, and then there's the investment selection decision. So if you've got a view that forward-looking returns for most traditional asset classes are probably going to be low from here, and that you want diversity and other sources of alpha outside of that, then alternatives clearly at a philosophical level make a lot of sense. But then when you get, we see lots of dealer groups with portfolio allocations to alternatives there. But then then you've got to select an alternatives fund or some type of investment to populate that with. And that's where a bit of the breakdown happens, because we sort of look at the universe out there and philosophically alternatives make sense, but then you're going to then find a strategy that in most cases you want has genuine non-correlated alpha, has diversity built in, doesn't cost an arm and a leg, has daily liquidity and comes in an Australian domiciled unit trust with a PDS. By the time you layer in all of those factors, the universe of possible choices that you're left with that tick most of those boxes is fairly negligible. And so that's why I think for a couple of years now, we've certainly seen through some of these polls at the conference, people are more and more interested in alternatives. But when we look at the actual flow data, what is actually going out there, where are you actually allocating people's money? It just is not and has not been reflected in there for the most part. There's a couple of exceptions. Certainly, most of the money within that sector locally tends to populate in a couple of managed futures strategies, which have certainly been popular through time. But beyond that, if you look at where assets have actually flown in the local Australian market, it's been fairly nascent across the board, despite the fact that, as I said, philosophically, we seem to think it's a good idea. And when we're doing polling like this, everyone's indicating that it's, certainly for the last couple of years, that it's been their second preferred asset class after global equities. But the subsequent flows just have not backed up or supported that.
Let's talk a little bit about an asset class that many advisors in the room probably don't have a lot of control over, although they have to consider them in the overall weighting, and that's residential property. What do you think is your outlook for residential property here in Australia, and what would you advise that we try to guide the individuals in the market toward?
It's a great question.
Chris?
I mean, first of all, I think obviously. I mean, if your client has got exposure to Australian to residential property, I mean, it depends on whether they're actually investing in it or it's their home. And I think there's two very different drivers there. Obviously, if they're investing in unlisted property or residential property, then I think you really do need to take that into the total portfolio consideration, and what's going to happen if there's pressure on interest rates going back up, and what that means for them, and especially diversifying outside of Australia. There's just no doubt about it, and unhedged, by the way, too, because you really want to make sure that that you get the power of the currency if you do get some volatility globally. I would say if it's their home, then I think it's a different proposition, and so. But obviously fewer and fewer people are able to afford that.
This is the behavioural aspect, right?
Yeah.
So, if you're thinking about from a planning perspective in a whole of portfolio context, obviously a residential property, there's far more to that than just, I think that's going to be a good investment for the next 5 years, 10 years, whatever the case may be. The emotion and the behavioural aspects behind that are quite important. On any sort of valuation metric, yes, Aussie residential property, at least certainly on the eastern seaboard, certainly doesn't look cheap. But I thought it was an interesting comment from Anajit earlier in the fixed interest session, where he sort of made the observation that while many of these housing bubble metrics tend to be more and more common these days, if you go back through history, unless you see a really sharply rising interest rate environment, these things don't unwind. There's no bubble that bursts. And so that's certainly a fairly uncommon view to hear from a foreigner looking from the outside into Australian residential property, where you more often hear the American fund managers in particular say what a bubble it is waiting to burst, and it's going to blow up our banking sector and therefore the Aussie equity market by natural follow-on. So I thought that was an interesting observation on that aspect.
Definitely. I can understand the concern, though, given that there's certainly a lot riding on a continued strength in the housing market.
There is.
So,
and I mean,
Heather,
as we heard in the equity panel, right?
Yeah,
as we heard in the equity
That's
panel
the thing,
upstairs.
absolutely. And I think there is a lot of pressure on that. And I think there's a lot of pressure on a lot of industries at the moment. I think that's one theme I've seen come out of the conference today, when, people are, they might see pockets of opportunity through disruption and new technologies coming through, but there's a lot of areas which are struggling as well. And, in our equities panel, they were talking about some of the old media and some of the and what's going to be happening when the sporting bodies go to renegotiate for some of these contracts that they've got, and everyone's going to be taking a hit down the line if these contracts get priced at lower. There's a lot of people in the food chain in that regard.
Right. So while we're on the topic of individual equities, there was a session upstairs about some of the stocks that our equity analyst team finds interesting or attractive. So how do you guys think about advisors recommending or using individual equities in a broader portfolio context?
So I moderated that session, so I should start off with. There's a lot of ways that I think advisors can use individual securities in regards to maybe if there's a model portfolio context that they're they're following through an SMA or a different type of a product or a process which is rigorous, takes a long-term view and valuation, as James said before. Other ways that you can use it as well is if you invest into maybe an X20 product and, your clients have got exposure to the banks and resources and a few other names as well. We see and hear a lot of clients who are using that, especially in the SMSF world too. Again, I think you've just got to be very careful about, these securities that you're having and the mix and the role that they're playing in a portfolio. We actually see different views coming from, our David Ellis, our own equities analyst for the banks here in Australia versus some other fund managers. And I think a lot of the times, David's actually taking a true individual investor's view on, these companies and looking at the sustainability of the dividends, the pricing power that these banks bring to the market, and the growth that you should see over time from their position in the market as well. And so, I think whereas, again, fund managers are much more benchmark relative and thinking about relative valuations against different industries.
Yeah, I think there's certainly an argument to support, particularly from a specific tax lot management, harvesting franking credits, that type of thing. But as Chris said, you really do need the sort of appropriate, risk control, portfolio construction, guardrails, around that. What's the sort of, research insights or process that you're either doing yourself or pulling in from someone else? What type of, portfolio constraints, if you like, you want to think of it that way, are you putting on yourself to ensure you've got appropriate diversification and not putting all your eggs, in the one basket?
And this is also, as it relates to passive investing, I think at the moment we've just got very low volatility in all global equity markets in Australia and markets around the world. And I think, that will change. We will get a spike in volatility, and that's when you see much more dispersion in returns. And I think it's going to be a lot harder to beat the market in that regard too.
Right. Well, I guess this one is probably for James or Tim. Libby talked about left tail risks in her presentation this morning. How do you think about left tail risks in a portfolio construction context? James?
Yeah, so, I think a number of the presenters touched on this today, and it's the role of cash. Cash is obviously a terrible long-term investment. It doesn't produce a growing income stream. So in that respect, it's awful. But there are times in the cycle where it makes sense to hold elevated levels of cash. Cash preserves capital, it's liquid, it gives you optionality. And so it can be redeployed back into the market as and when opportunities present themselves. Warren Buffett once said that holding cash can be uncomfortable, but not nearly as uncomfortable as doing something stupid with it. And so I think that underscores the importance of cash in the current environment when valuations are elevated and when there is tail risk. Having that cash there ready to redeploy back into opportunities when they become attractive.
Yeah.
I'll just add to that. I mean, at a fund selection level, the way we think about it is you've got the sort of steady Eddie funds, or you've got the sort of swing for the fences trying to hit six funds that are usually first or last over a given time period. Generally speaking, we've tended to have a preference for more in the middle because they deliver more consistent outcomes. And then again, going to some of the behavioural aspects we touched on earlier, they're the funds that those swing for the fences funds tend to be the ones that are used worse and have worse timing. So if you are interested in using some of these more left tail possibility funds that are more out there, whether it's super concentration or taking a particularly focused risk in one area, I think you've just got to go in eyes wide open, size it accordingly in your portfolio, and really make sure you've got other portfolio elements that should do well in the event that left tail risk, that particular investment does play out.
So maybe a good segue to that, or a follow-on from that for you, James, is what role can cash play in a multi-asset portfolio?
Yeah, in the long term, I'd say not a very important one, but at times a really, really critical role. Investors, I don't think, should be afraid to hold it at certain times in the cycle.
I actually, our investment management team have got, relatively high cash weightings across a few different of their portfolios at the moment. I like to give James a bit of stick about it every now and then. But what I love about it though is when you're looking at the performance of markets that we've seen over the last few years, where you have got pretty good returns from equities, infrastructure as well has been playing out really well. I think when you think about the clients having comfort and the fact that no matter, we've got some good returns from this part of the portfolio. This part of the portfolio is also playing a really important role because it's just giving us some comfort about, we don't know what market's going to do. We know there's a lot of volatility. Well, there's not a lot of uncertainty out there at the moment. So just being, holding some back just for times when we want to be deploying it and using it, I think is a really, really sensible thing to be doing in the market conditions. It just means your clients are going to have slightly more subdued returns. But when you've got double-digit returns from markets, I think it's a good conversation to be having with your clients, for sure.
So a question from the audience for you, Chris, is that given the lack of options in alternatives, how open would you be to considering using offshore ratings and track records for liquid alternatives?
Okay, so not very. Is a short answer. I mean, I think one of the strengths that we have at Morningstar, and I think we've got this over pretty much the vast majority of our competitors, is we're a truly global research firm, and we're connected globally in terms of our analysts. We divide along sector lines in terms of our how we analyse funds. So Tim Wong, who was moderating the global their active versus passive conversation, the panel that we had today, he's our fixed income leader for Asia Pacific. He works very closely with Miriam, who's obviously in town and moderated the fixed income panel. So there's a lot of connectivity with our analysts globally. We've got over 100. We speak, we engage with each other, and we've got a pretty good understanding about what global coverage is and what 40 Act funds are, or which is basically US mutual funds, by the way. So what US mutual funds are out there, and the good ones especially, that might be relevant to Australian investors. But first of all, you've got to be an Aussie retail fund for the vast majority of our clients to invest into that. So we take a view from a local market perspective. And then quite frankly, when I look at the alternative coverage that we have in the US, it's not that great either. I don't see anything.
The view on funds is not that great as opposed to the coverage isn't that great.
Yes, sorry, I should say that. The view on the funds
we have plenty of coverage,
great.
but as US has many of the sort of similar issues I alluded to before. When you structure these things in daily priced, collective pools, it does severely limit some of the strategies and how they can be implemented. And so, getting at the question, I think it really depends, because depending on the type of strategy, you bring it here, you hedge it into Aussie dollars, can change the dynamic of the actual strategy altogether, how that then interrelates with other portfolio components that you've got here. So an Australian investor is going to have, not often, in pretty much all cases, going to have quite different asset allocation to a US investor or a UK-based investor. So I think particularly in alternatives is the one area where certainly some of the underlying skill sets can be transferable, but there's a lot of practical implementation issues that can make some material differences when you translate to a local rating and view.
So this is a great question, thanks to whoever submitted it. How can you reconcile your comments on adding cash to the portfolio opportunistically with staying the course and avoiding the pitfalls of human behavior?
That's a great question, James.
Yeah, I think so. That's right. Thanks for that. So, look, the pitfall against human behaviour really that I'd be most concerned about is the tendency to buy assets after they've risen and sell them after they've fallen. And so buying cash is consistent with that, absolutely. Effectively moving cash or selling assets that have done well, cashing up now, redeploying it back after they've fallen is completely consistent with a better approach, a more rational approach, better behaviour for investors.
And when you look at the strategic asset allocation that we have within our model portfolios and for our clients as well, for many years we had very low levels of cash. And it was only really, I think, probably 3 years ago where we really did make a larger allocation to it. And I think the key driver for that was really just understanding where we are in the market cycle when it comes to relative valuation of fixed interest and things like that, and really putting it in that way. So I think you do need to take a long-term view, but you also need to be conscious of relative market valuations and the market cycle as well. Is that fair?
Yeah.
Or not?
Yeah, absolutely. So take a long-term view, but invest according to value. So don't necessarily invest in overpriced assets for the long term. Think about the kind of assets you're investing in. Cash in that context has a really important role.
Well, we're getting to the pointy end of it. So Tim, any final thoughts on portfolio construction from your perspective?
The old adage, don't put all your eggs in one basket. I think the one thing we probably haven't talked about is just, we heard Scott in particular talk about technology, and I guess if I think about investments and where we see technology having an influence in the style or approach to investing, sort of goes towards the strategic beta discussion that was had upstairs in the breakout room. I'd say that's so. Just for terminology's sake, what's more popularly known as smart beta is a term that we refuse to use at Morningstar. It's fairly naturally loaded, of course. Some of the outcomes there will be good, some of them less good. So we use the term strategic beta to refer to this ever-growing universe of sort of factor-based, rules-based strategies that aren't typically market cap weighted. But where we sort of really see the technology comparison there is what that's attempting to do is, I guess, democratize the active management industry in many ways at a lower fee. So we know that fees are coming down. That's a structural trend that ain't going to reverse. And so you've seen passive on one end of the fee spectrum continue to grow and continue to lower its costs accordingly. Yet at the active level, the traditional active level, we haven't really seen much movement in the fee regard yet. The average Aussie equity fund still in that 95 to 100 basis point range. The average long-only global fund is more in that 110, 120 range. You haven't really seen much movement in there. And so to the extent where some of these factor-based strategies are able to capture some of the activeness that's traditionally played out there, and if we think about, obviously being a fund researcher, you sit in front of hundreds of managers on an annual basis or multi-year basis, and particularly in an equity context, most of them tend to do some version of we buy high-quality stocks that are cheap and going to grow over time. But most 90% of managers at least are some combination of one of those three things. Whether we can sort of dress up stories around that, as most do. Obviously, our job is to try and see through that. But to the extent where some of those elements can be captured through appropriately designed strategic beta offerings and then delivered at cost points that are a half, a third, a quarter of what that sort of 1.1, 1.2% traditional fees are. That's to me where I see potentially technological disruption in the active management space really playing a role as people focus more on cost and really use that as a way of getting that exposure to the high quality, high growth, low cost, or low value stocks over time. Now, the challenge of that, of course, is that it's not that simple. And so we've spent a lot of time when we're researching these strategic beta, both ETFs and funds, sort of getting really deep into the methodologies behind these things, because some of them are relatively robust in terms of how they package the end solution and the rules that go into that, but some of them are frankly fairly superficial and have some natural flaws that will tend to get found out through a cycle. So at a portfolio level, I think the emergence of this area as a range of new tools in which to get access to traditional factors that you've had to pay full price active management for, but those being delivered in a more systematic way at a much lower cost, to me I think that's probably the most interesting and certainly emerging and growing area of portfolio construction out there.
Chris, parting thoughts for the group?
I've got a couple just very quickly. I think there's I don't want people to confuse the comments and the discussion we've had today on cash with this view that we're trying to time markets, or I think as much as anything, a lot of this actually relates to the capital markets work that James does and our investment management group does, and their views on the model for portfolios. And I don't think it's that different to what you're seeing in a lot of fund managers in the market where they've got slightly high levels of cash at the moment, just given where they're seeing relative valuations and the opportunity set. So I just want to make sure that people are aware of that. The second point that I would make is in regards to, it's just very difficult at the moment, I think, to really understand what investment themes are worthwhile following, and so I just really think it's very important to be nicely diversified across assets, and just be mindful of downside risk.
James?
Yeah, so if you think about, there are effectively three key ways in which investors can seek to add value in markets. The first way would be through having an informational advantage. And I'm talking about means of outperforming, so it means having better information than the rest of the market. The second way would be through an analytical advantage, so making better decisions based on better analysis. The third way in which you can outperform the market is by having a behavioural advantage. Really, the behavioural advantage of those three is by far and away the most sustainable, by far and away the most enduring. So behaving more rationally. And so if nothing else, I think that's really important right now today in the current environment.
Well, thank you all for sharing your concluding thoughts with the group. I invite you all to join us for a cocktail, and before we head out there, Tim has some concluding remarks.
I do. Thanks, Heather. So we've reached the end. Thank you all for your participation, attendance today. It's been great. The engagement, the questions, your polling answers, your feedback certainly has been fantastic. Again, on that feedback theme, encourage you to complete your feedback on each of the sessions. We really do value that, and we really want to use that to take the conference to another level again in 2018. So thank you to all of you. A couple of other thank yous out there. Thank you to our events and marketing teams. So Monique, Teresa and Christian done an inordinate amount of work behind the scenes to make an event like this happen, run smoothly as it has. So thank you to you guys. That's been fantastic. We do have a number of prizes to announce. Obviously, there was a number of competitions going out in the sponsors hall, so if we could have those up on the screen. So thank you to the sponsors for your support today. Thank you for providing these, and if you see your name up here for one of these prizes, congratulations, well done. You'll be able to collect your prizes at the desk out the front there where we came in after this. And so on that note, we draw to a close. Hopefully you've enjoyed the day. We've certainly had a range of speakers, starting off from a bigger picture, US public policy perspective this morning with Libby. We've dug down into the micro issues across multiple asset classes, and then hopefully we've drawn that together for you now to give you some key things to take back and think about as you go back to building portfolios for your clients. So thank you again. Join us all for a drink outside. We look forward to seeing you for the 12th edition of this conference next year. Thank you.